I'm now going to be talking about challenges for the UK pension system and making the case for these pensions review, really building up on the points that Alistair just made. So in recent years, we've seen a lot of good news stories about pensions and pensioners in the UK. So average incomes of people above the state pension age are now at similar levels as the average incomes of those below the state pension age. Pensioner poverty rates are also below the national average. And thanks to automatic enrollment, we've seen a huge increase in the number of employees who are saving into private pensions. So you might think, well, maybe we don't have to worry about the pension system very much at the moment, given these big policy success stories that we've heard. However, there are a number of underlying risks and challenges in the current pension system when we're thinking about future retirees and their financial security in retirement. Now, the last review we had was the Pensions Commission in 2005, and of course a lot has happened in the last almost 20 years. In terms of the macroeconomic picture, we've seen a lot of macroeconomic instability caused by the Great Recession and pandemic, as well as other things. As a result, we've seen these falls in long-run risk-free interest rates and other asset returns. And we've seen the continuation of other macro trends, such as the growth in self-employment, so this group of people who are not covered by automatic enrollment, as well as declines in home ownership. When we're looking at life expectancy, the increases in life expectancy has stalled in the 2010s in ways which we did not expect to happen in the early 2000s. When we're looking at private sector pensions, we've seen a continuation of the trend where defined benefit schemes are less and less prevalent. And finally, when it comes to policy change, we've seen a lot of that as well. So some of this was proposed by the Pensions Commission back in the mid-2000s, such as the phasing out of the earnings-related part of the state pension and the introduction of the new flat-rate state pension. But some of them were not even being considered back in 2005, such as pension freedoms. So what I'm going to do today is set out key 5 challenges for facing future pensioners, really, again, building up on the points that Alistair made. And I'm going to talk through each of these in detail, but we can group these challenges into sort of 3 broad themes. The first 2 have to do with saving into pensions as well as into housing. The third and fourth challenge have to do with the role of the state, especially given the public finance challenges. And finally, we're going to be talking about the difficulty and risk in managing finances through retirement. But what's really at the heart of all of these issues is the fact that compared to current generations of retirees, current workers are going to have to bear a lot more of the risks associated with pension saving, whether it's longevity risk or investment risk in particular. So that's really going to be the overarching theme throughout this talk. And I'm going to start with the first challenge. So many people are only saving very little for retirement. First, looking at participation, this is the good news story part of this. We know that in the public sector, throughout the last couple of decades, we've seen very high participation rates. So about 90% of public sector employees are saving into a pension. However, in the private sector, this looks very different. So throughout the 90s and early 2000s, we saw less than half of private sector employees actually saving into a private pension. That proportion was falling as well, until we saw the introduction of automatic enrollment, which reversed this trend. Now, of course, it's worth noting that all of this increase in private sector participation has come, pension participation has come in the form of defined contribution schemes. So back in the late 1990s, more than a third of private sector employees were actually saving in a DB scheme, whereas now that's only around 1 in 10. And the opposite is true for DC schemes. And of course, one of the features of defined contribution schemes is now all of the risk, the investment risk of saving into your pension. So the fact that how much money you have in retirement will depend on how well your investments do over time. All of that risk now lies with the individual rather than the employer, and there's no sort of pooling of that risk across individuals or generations. So with this shift from DB to DC schemes, we've seen a big risk transfer from employers to individuals. And that's also happened at the same time as we've seen really big falls in the rates of return that people can expect to receive on their pension saving. So the Pension Commission, in their sort of base case, assumed that the real rates of returns that you would be receiving on your pension in their modeling would be 2% on government bonds, 2.7% for corporate bonds, and then 6% for equity markets. But of course, we know that these kinds of rates of returns are no longer really realistic or applicable. So the FCA allows financial services companies to use or they set a maximum rate that financial services companies can use when they're making projections for future pension pot size and future incomes for their retail customers. And the latest assumptions that they have for which underlie that maximum rate are at least 2 percentage points lower for each of these asset classes than what the Pensions Commission assumed. Now, of course, the other big factor in determining the size of your pension pot in retirement is how much money you're actually putting into your pension. And we know that the amounts that are saved into pensions are, on average, low. So what I'm doing here is I'm taking the middle fifth of earners in the private sector, and then I'm showing what proportion of them have total contributions of less than these 5, 8, and 15%. So first of all, looking at 5% of earnings, actually very few people are saving these small amounts into their pension, which makes sense given the automatic enrollment minimum default rates. If we're then looking at 8%, you can see that majority of people, so 61% of people, are saving less than 8% of their pre-tax earnings into their pensions. And now 8% might seem familiar because that's the sort of total contribution rate implied by the automatic enrollment minimum default rates. But of course, that's set as a percentage of qualifying earnings rather than total earnings. So this just makes the point that actually most people are saving less than 8% when you're looking at their total earnings. And then finally, the Pensions Commission recommended that maybe something closer to 15% would be a more appropriate savings rate for middle and high earners in particular. And we can see that very few people are saving those kinds of amounts. And this is very different in the public sector, of course. So over half of those in public sector DB schemes get an employer contribution of at least 20% of salary, and that's just the employer contribution. So there's this really big divide between the amount that is contributed into pensions in the public and the private sector. And finally, I want to highlight one group of people for whom even participation rates are very low. So we've seen a big increase in the number of self-employed workers in the UK over the last few decades, and before the pandemic, there were about 5 million self-employed workers in the UK. However, this group of people do not fall under the automatic enrollment rules, and actually we've seen this quite a dramatic decline in the number of self-employed workers who are saving in a private pension. So this is another challenge. How do we engage with these people who are not benefiting from automatic enrollment? Now, of course, another group of people who also do not fall under automatic enrollment rules are those earning less than £10,000 a year. And while the self-employed majority of the self-employed workers are men, because part-time work is more prevalent among women, the group of people earning less than £10,000 a year are predominantly women. So this just illustrates how these differences in labor market experiences during the working life will then translate into differences in pension incomes and pension wealth through pension saving rates. And now moving on to the second challenge. So far I've been talking about private pension saving, but of course other types of saving matter as well. And as we heard, we now have increasing numbers of people living in private rented accommodation, also at older ages. And that's because of the fall in home ownership as well as social renting. So if we're looking at people who were born in the 1930s or the 1940s, and we're looking at them at age 65, only about 3 or 4% of them were living in private rented accommodation. You then look at people born in the 1950s, that's already about 6%. For those born in the 1960s, it's looking more like 10%. And then unless something changes quite dramatically in terms of inheritances or something else, we think that those rates might be even higher for people born in the 70s and 80s. So, of course, the implications of this is that when people are living in private rented accommodation, they have less housing security, and also it's a more expensive form of housing. So either people are going to face a lower standard of living, or they're going to have to save more during their working life, or the state is going to have to step in and provide more housing benefits. So this is another challenge when it comes to private saving. So what is then the role of the state here? We've seen big increases in the state pension age in recent years. So we saw the equalization of the state pension of women from 60 to 65. And we've also seen an increase for everyone from 65 to 66. And there are further increases legislated to 67 and 68. And of course, increasing the state pension age is one coherent response to the public finance challenge coming from increased longevity. But rising the state pension age can lead to challenges for the affected age groups. Previous IFS work shows that the increase in the state pension age from 65 to 66 led to an additional 8 out of 100 65-year-olds to being in paid work. So you can see that it does change, the increase in the state pension age does change behavior for some people, but by no means for all. And actually, increasing the state pension age will cause the most financial risk for people who find it more difficult to delay retirement in response to the increased state pension age. So those in poor health, those with caring responsibilities, and those who are involuntarily unemployed. And in addition to looking at the impact on employment rates, we've also looked at what's been the impact of increases in the state pension age for income poverty rates. So what I'm showing here is the relative income poverty rates of women of different age groups. First, women aged 58 to 59 have, throughout this period, always been below the state pension age. And the measure is a bit noisy, but the relative income poverty rate has remained relatively stable. Now, if we then look at the women aged 60 to 64, before 2010, all of these women were above the state pension age. So they were eligible to receive this now £10,000 per year from the state. And then the state pension age for this group gradually increased, and by 2018, all of these women were below the state pension age. And you can see that as we've seen this gradual increase in the state pension age, we also saw a gradual increase in the relative income poverty rate among this age group. And then if we're looking at women aged 65, who saw an increase in their state pension age from 65 to 66 between 2018 and 2020, you can see this relative income poverty rates spiking up. And again, previous IFS work shows that if you look at all men and women who were affected by the increase in the state pension age from 65 to 66, their absolute poverty rate is about 24%, which is more than a doubling of what it would have been had the state pension age stayed at 65. So these are really big effects. And of course, a lot of this is because of the change in nature of benefits, where we've seen an increase in the generosity of state pension compared to benefits below the state pension age. And as we keep on increasing the state pension age, we also expect more and more people might struggle to continue to work. And that's because we see high levels of disability around the state pension age. So here I'm showing the proportion of people who are disabled by age group. And you can see that there is a lot of, the rate of disability for those in their 60s, and especially in their late 60s, is quite high. And what's more is that for those with lower levels of formal qualifications, these rates of disability are even higher. So because the rates of disability are higher among the less educated groups, and those with poor health are more likely to find it more difficult to continue working, this further increases in the state pension age may lead to increases or widening of the existing inequalities in incomes and wealth between these groups. Now, of course, the government could try and deal with this by throwing money at the problem. But that's going to be very difficult because of the significant pressures on public finances that we're already seeing in the coming decades. So here I'm showing the forecast spending from the OBR on state pensions and pensioner benefits as a percent of national income. And what you can see is that compared to 2021, we expect to be spending about 4% more of our national income on state pensions and pensioner benefits by 2071. And that's equivalent to about £100 billion into today's term being spent on these state pensions and pensioner benefits. Now, the recent independent review of the state pension age suggested that we should cap spending on state pensions at 6% of national income. But as you can see from here, the OBR predicts that we would already be breaching that level before the 2050s. And it's not just about state pension and pensioner benefits, of course. We're also expecting to see really large increases in spending on health and adult social care, going from 10% of national income at the moment to 17%. And of course, the reason for all of this is the fact that our population is aging very rapidly. So first, what I'm showing here is the proportion of the adult population over the age of 65. And you can see that that actually started increasing already since the 2010s as those large post-war generations started turning these ages. But because we've seen these increases in the state pension age over this period and continue to see some legislative changes as well, the proportion of people above the state pension age has actually remained at a relatively stable level, and it's only really starting to increase through the 2030s and the 2040s. So this just illustrates why it is that we're projecting that large increase in spending on older people. And now the final challenge that I want to talk about is the difficulty and risk in managing finances through retirement. So back in 2014, this quite an unexpected and new pensions policy was announced called the Pension Freedoms. So this removed the near compulsory annuitization of DC pension pots. And the effect that that had on annuity purchases was immediate, it was stark, and it has been sustained. So here so you can see that as soon as this was announced, we saw a fall in annuity purchases, and there hasn't been really a recovery of that level since then. So what are the implications of this? Well, of course, it might be, the fact that people now have more flexibility and freedom in deciding how they want to spend their pension wealth in retirement can be a good thing because it provides people flexibility to draw down on their pension wealth in ways that matches their spending desires. However, whatever decision people make at retirement on how to draw down their pension wealth, those decisions are very difficult to make and can have very long-lasting impacts because people tend to spend years or even decades in retirement. And the key risk here is longevity risk. So people don't know how long they will live for, so they don't know how fast or slowly they should be drawing down on their wealth. And as we have less and less annuities, more and more people are going to be more exposed to the longevity risk. And just to illustrate that point a little bit more, we know that for those men who aged 66 this year, their average life expectancy is 85, and for women it's 87. But if we then draw a curve showing what proportion of the 66-year-olds make it to each of a consecutive age for men and women, you can actually see that a quarter of men die by age 79. So these men would have to, when they're planning their pension saving at age 66, they would have to make sure that their pension wealth lasts them a maximum of 13 years. However, another quarter of men live beyond 91. So these men would have to make sure that their pension wealth lasts them 25 years or longer. So this just really illustrates the point of why it's so difficult to manage your pension wealth without an annuity. And just to wrap this all together, I'm going to talk about some of the risks borne by individuals in the current system. So pension planning is inherently complicated and requires dealing with different risks and uncertainty over an extremely long period of time. I've talked about longevity risk, I also mentioned investment risk earlier, and of course policy change can also create uncertainty. Making decisions about saving also requires financial literacy, it requires being forward-looking, it requires understanding of financial products. And one of the key changes in the UK pension system, as has hopefully become clear throughout this talk, has been this risk transfer, where the risks associated with pension saving have been increasingly transferred from the state, employer and insurance firms to the individual. So from the state, because we've seen this phasing out of the earnings-related part of the state pension, which was particularly important for middle and higher earners, from employer with the shift from DB to DC schemes, and from insurance firms as we have less and less annuities. So it's now down to the individuals to make those really complex and active choices around how and when to save for retirement, and also how to then use up their pension wealth in retirement. So in this presentation, I've illustrated why it is that we need to do something about this now. There are lots of challenges and risks when it comes to financial security of future retirees. And we think it's time for policymakers to act now so that we can make a difference for the current generation of workers. These policy changes are going to take years or even decades to feed through, so we cannot get complacent just now, just because policy changes of the past mean that the current retirees are doing quite well. So what is the Pensions Review? So the Pensions Review is a multi-year IFS-led review of pensions in the UK and the future of financial security in retirement. And we're working in partnership with Aberdeen Financial Fairness Trust. And we're going to be focusing on the challenges ahead for future generations of pensioners. And also, we'd like to, at the end, propose really concrete policy recommendations and options for policymakers. We're going to be publishing a series of reports through the next 2 years, with then a final recommendations report in early summer 2025. We're looking at 3 key strands of work. So are people saving appropriately for retirement? What is the role of the state, especially given the public finance challenges? And then do people require more assistance when it comes to how they should be using their wealth in retirement? And what we really want to do over the next 2 years is to engage with a lot of various stakeholders. And so we, of course, want to assess the views of the general public when it comes to pensions and pension saving. And then we also want to benefit from the views and expertise of policymakers, pension industry, trade unions, employers, consumers, basically people in this room. Some of the examples of engagement and dissemination activities that we're planning to take on include opinion polling and public engagement, which is commissioned by Aberdeen Financial Fairness Trust. We're also going to be holding various types of meetings with stakeholders. And whenever we're publishing our interim findings throughout the next 2 years, we'll also be holding public events around those reports. So we really do want to hear from you. So please do come talk to us after this event. Of course, looking forward to Q&A as well. And please feel free to get in touch with us after the event as well, either directly or through this Pensions Review email address. Thanks very much.